Okay, hey everyone. So I'm going to break this week's lectures into two parts. This first part will be going over net present value and risk. The second part will be like looking at long-term investment decisions. They're all kind of related. They're doing the risk and like how looking at like the earnings are, weighing that versus the cost. Like as far as I make the decision on whether to, to expand or like do something with your business. Okay. So this first term we're talking about is called net present value. So this is you're looking at, when you look at the present value of future streams of money, you can't just look at it in dollar amounts. All right, you have to discount the future, like in future periods. So money's not worth as much in the period as it is now. That's why, it costs money to borrow money, because somebody could be using it for something else now. So for them to forego using that money or give it up, they need to be rewarded. All right. And so this is for the way, any things like you could think of it maybe in the terms like what you have to borrow, like your like if you have to borrow money from a bank, like the interest payments, that's what you would need to discount each future period. And it's going to compound too as well. All right. The net present value, this is when you take the present value of some investment project here, and you're going to subtract the initial outlay, the initial cost that you're doing. Okay. And so if this is positive, like if the present value of your future returns is greater than this initial cost, well, it could be something you may want to think about doing. But if it's less than that, if the present value of these expected future returns that you get, if it's less than your initial cost, well, that's not going to be a good investment. It's not really something you want to do, because like something else could go wrong and make it even worse. But here, when you're planning things going as expected, you're still going to lose money. So it's definitely something you want to consider doing. All right. Whereas if it's positive, well, maybe you'd want to do it. Like it's a good, okay, let's go ahead with it because it can be profitable. Okay. So you're kind of familiar with, the future value or something. This is like when you're saving or investing something. That is, let's say, you're going to put $1,000 into the bank. Well, what would it be worth in a year? What's the future value of this $1,000? Well, you take this $1,000, you multiply it plus one, plus whatever interest rate that the bank's offering you. Okay, and do that, and that'll give you your future value in 1 year. All right. Now, to solve for this present value, what you have to do is you want to isolate this present value by itself on one side, and so you just need to divide both sides of this 1 plus r, and that can give you this present value. Okay. So let's say, if you want to have a certain amount of money, never mind, I'll get to that later. Okay. So here, like, what's like if the future value expected to be $1,100, well, what's the present value? Well, you need to take that, divide it by 1 plus whatever borrowing costs are, or like what interest rates you can get. Let's say it's 10%, so you divide it by 1.1. So it's going to discount, it's going to be less because it's into the future. And money now is always worth more than money into the future. Okay. And then from that, you determine your present value. And then to get your net present value, you need to subtract out your initial cost. Okay. So if you're planning on expanding your firm, you're going the investment is going to cost $100,000. Well, you need to determine the present value of like the future revenue it's going to generate and subtract out by this 100,000. Okay. And so that'll let you know whether it's, positive or negative. If it's positive, the net present value is positive, well, then you might want to go ahead with it. If it's negative, well, then you definitely wouldn't. All right. So one thing to keep in mind as well here is as you keep going further and further into the future, all right, like to a second, third, and fourth year, this is going to compound. The money's worth even less. All right. So if you're going more than like one period into the future, well, when you're determining your present value, and we're trying to get the present value of an income stream like 3 periods in the future, well, you got to take 1 plus r, the interest rate, and then raise it to the 3rd power. Okay. All right. So you're going to discount it even more the further it is in the future, because the further away it is, the less valuable it is to you. Okay. All right. So here's an example where you use net present value. So here, let's talk about pensions and, okay, well, how much money do we need to have a certain amount in the future? Okay, so the pension needs to pay out here in Nashville. It needs to be able to pay out 100,000 in 20 years from now. So, well, okay, well, how much do we need to put up now in order for it to be able to pay out that in 20 years? All right, and so you use this present value formula. Okay, and what discount rate do you use here? Well, at first they're given their discount rate of 8.25%. Okay, so we want to know what's the present value of 100,000 20 years from now with a discount rate of 8.25. Okay, so I'm not going to go too much into this, like solving it, but like stop the video, make sure you can like solve this out with your calculator, and we'll go into more detail. Like I'll solve some problems when we get into the class. That's what I'll try to focus more on during the class time. That way you can ask questions too when I'm working through stuff. But anyway, so to determine this present value, or what you need to put into this pension plan in order to have 100,000 20 years from now with a discount rate 8.25, you take the 100,000, you divide it by 1 plus the discount rate, 0.0825. That's what it is when you put that in decimal form. It's 0.0825. But then you need to raise it to the 20th power because like it's 20 years into the future. Okay, and what it gives you is $20,485. All right. So if the city invests $20,485 and there's 8.25% off whatever it invests in, then the savings will compound and you'll have 100,000. This is kind of unrealistic. Okay, this is a really high return. Maybe it's not really that realistic, but a lot of times it's popular to for this to be the case. Well, why is that popular? Well, it's because like you have to spend less now currently. You have to save less, put it away, if you figure for this higher amount of return. All right, but if you look at a more realistic discount rate where you get an earnings of 6.5% each year on average, well, then you got to save a good bit more. All right, the present value then becomes 28,380. Right? And you can see why this would be less popular too, because like you'd have to put in more money and save more current in the present to have the same amount in a later time here. Right, but it's good so sometimes this is why sometimes when you look at this politically, sometimes you may do something that's unpopular, but you need to do things realistically. 8.25 like would be kind of unrealistic expected returns here. Okay, and that's the way this present value works. Like, get this: if the discount rate increases, all right, when you're looking at a future amount of money later on into the future, well, the present value is going to decrease. But if this discount rate decreases, well, the present value is going to increase. Okay. All right. So yeah, we'll go over some problems to kind of show this why this works. But like I said, if you want to stop it and make sure you can solve for these the video, do that. That would be good. All right. So here we're going to look at two separate projects. One of them is going to return an income stream 1 year from now, and the other one is going to return income 1 year from now and 2 years from now. Okay, and so we'll show the difference between when you don't use this present, when we don't discount it and use the present value like we do, what it can show, and it could confuse you and make you believe something would be a good investment when it's not. All right, so project one that this manager decided to undertake, if it's okay, if we make this investment, this will give us a revenue stream at the end of the first year here of $115, and that's going to be it. All right. So if you don't do the present value and discount it, what this is going to show, there's going to be a net of $15. That is, you're going to bring in $115, and it costs $100. So you subtract that out, and you have 15 for your net. All right. So it's positive. It's a positive profit. It would make sense to do that possibly. All right. Whereas project two, it's the same way. It's going to cost $100, this initial investment, but it's going to give you $60 of revenue at the end of the year, and then 60 more 2 years from now. Okay. So what does this show? This shows that, well, you have $120 of revenue coming in. And if you don't discount this using the present value, well, it's going to show you with a net of 20 bucks, right? 120 minus 100 will give you 20. Right? So here, not only is this positive, it's actually showing this will be the project 2 will be the one to do, because you're going to, without doing the present value, it's showing that you're going to have a higher net. All right, that's not the way you should do things, because it costs the company money to raise capital. Either through like issuing bonds or issuing stocks. It's like it costs them to do that borrowing. They got to pay on that each year. When they make this investment, they got to borrow it and they got to pay interest on it. So you need to make sure you discount it to give you an idea of whether it's profitable to do it or not. So let's see how this changes it. Well, for project 1, if you discount this 150 bucks by divide this 115 by 1.14, it's going to give you $100.88. All right. So this is your present value. And so your net present value would be 100.88 minus 100. So you have a positive net present value. So it could be something you want to do. So it's actually positive. But now let's look at this other one. It actually showed, without doing the discount, that the net was higher. Like, as we'll see when you discount it, it's not the case. All right. Because if you discount this 60 bucks 1 year from now, that is, you divide it by 1.14, you'll get 52.63. Right? But when you go to the 60 bucks, it's 2 years from now, you got to discount even more. You got to compound that when you're discounting. So you're going to take the 60 bucks, divide it by 1.14 raised to the second. And when you do that, you get 46.17. Right? And so if you add these together, you subtract by 100, you actually get negative here. So this would be something you wouldn't want to do. Right? And this is the way you should do it, because it costs the company money to raise capital, like if they're to make these investments on these capital goods and stuff, or any type of investment they do. All right. So yeah, so like if you want to stop the video, like I said, anytime to figure these out. And this is the thing, if you're having trouble and you can't get these, be sure to tell me, let me know in class, or send me an email or whatever. And we'll go, I'll cover them, like I said, in class more, and hopefully everybody can get these. All right. So here, to determine the profitability of investment, remember this simple rule that we just showed, discounting the future benefits of the investment. You want to make sure you do that. Right? And you want to compare them to the current costs. You can't just, look at it. You got to make sure you take into account the borrowing cost, the interest that you have to pay on that. Okay. So this is what companies do. They use these discount rates, which, this is determined by their cost of capital. That's how they determine the discount rate. All right. It's however much it costs for them to raise capital. Okay. And so, like I'd mentioned before, this cost of capital was a blend of debt and equity. Debt would be when they issue bonds to raise money. Equity is when they issue stocks, okay, to raise money. And they'll weight this average here, what it costs to do this. And this average of the cost here, this interest rate they get from that's what they use when they're trying to determine their discount rate, right? When they want to find present value. All right. And so, like I said, time's a critical element in these investment decisions. Like when this income stream's coming in, how far in the future, you got to take into account that, and you got to discount it by how far away this revenue is going to be raised here. Okay. And you discount, like I said, by using this cost of capital. And so the NPV rule, if the present value of the net cash flows, all right, when you discount them, like depending on how far in the future they are, and what your cost of capital is, your discount rate. If it's larger than 0, all right, that means the project could be profitable. You could earn more than the cost of capital. So it could be something you want to do. It doesn't. Now there may be something else that you could do that'd be better, right? But if it's negative, it's something you don't want to do. Like it's just not. It's not going to be profitable. So it's something you definitely wouldn't want to do. All right. And so the way to think about this, these projects with a positive NPV, net present value, they're going to create, a positive, they're going to create economic profit. Okay. And so all these positive NPV products can actually return more than the company's cost of capital. So sometimes you can have these projects with this negative NPV, and they may create accounting profits, but not actually economic profit. You got to take into account, you got to discount stuff. You got to take into account these borrowing costs. If we don't include that, it may show you that earning a profit, but you're really not, like as far as economic profit. All right. And so, of course, obviously, when you're making these investment decisions, you're not going to choose a project unless it has a positive net present value. Okay. That doesn't necessarily mean, you're going to do it. Like, there may be another project, or there may be a high risk associated with it. Okay. So if it's positive, but like there's this wide range of outcomes you think, and the risk is kind of high, well, maybe still maybe it's not a large enough net present value to overcome the risk. Right? But you definitely can rule out stuff that's negative. Okay, I definitely don't want to do this. Right? And so it kind of brings us into this next thing where we're talking about risk. All right. So what you may do if a project or investment has a higher perceived level of risk, right, you may want to require a higher rate of return as a result of that. Okay. So what you would do is like, okay, this is a little bit higher. So let's, maybe our borrowing costs are this, but let's use a discount rate a little bit higher because this is kind of a risky project. Maybe the revenue, is susceptible to not being constant, or like susceptible to some sort of shock where you won't earn as much from it, or something could go wrong more likely. Well, you want to discount it at a higher rate, and then try to take into account the best you can the fact that there's risk associated with it. And so the reason they're doing this, like I said, this makes it a larger hurdle to have a positive net present value if you raise this discount rate to try to account for the higher level of risk here. So this is going to make your present value lower and make it less likely that it's positive. Okay. And this is a big issue for managers, trying to evaluate the level of risk associated with any investment here, right? And then trying to translate into this discount rate. This is kind of a difficult thing to do, and not being able to do it well can cause projects to go bad, or like the company to lose money as a result of it here. So this is a big thing for managers to do, to be able to evaluate this risk well. Some people do it better than others. Now, sometimes you can just get kind of lucky and stuff doesn't go wrong, but over the long run, the managers that are better at doing this are going to be more successful. Their company's going to be better off as a result. All right, so just in case you're not exactly sure what risk means, it means when you're kind of uncertain of what the outcomes, there's several different outcomes that can happen, right? So when there's variability in the possible outcomes, and the probability of those outcomes can be specified by the decision maker. So you're aware of these different outcomes, all right? But you're not sure which one's going to take place. You can kind of weight them, like give them a certain probability that is a percentage chance that they'll happen, and this can help you better make a decision, like better weight the risk as well. Like what's the likelihood this can happen? If it's really low, well, then you don't want to raise the discount rate too much if you're trying to do that, because if this is not very likely to happen, you still want to take account of it somewhat. Okay. All right, to kind of show this relationship between the expected return on investments and how it adjusts with risk. We'll take, here we're looking at these debt securities. All right, so U.S. Treasury bill, it's going to yield on average, this is like taken from 1970 to 2013. On average, the U.S. Treasury bill will give a yield of 3.5%. Now, these Treasury bills are short term, like 6 months to a year. And since this is the Federal Reserve that prints money, has its own print press, the U.S. has a large military, there's really not much danger that they're going to not pay their debt. So this is about as risk-free as you can get. So there's probably no risk here. It's short term, 1 year. You don't really have to worry about inflation risk with this. So you have a yield of 3.5% here. But as you start adding more stuff to this, all right, you have these Treasury bonds. They're 25 years plus. So there's some risk associated with this. Maybe something could go wrong in 25 years. That is a long time. Or more than likely, like you have inflation risk associated with this. So you're stuck in with a bond paying a certain rate of return, and then like inflation rises really, for whatever reason, like it has recently, it raises like 8% or 9%. Well, then you're going to be losing money. It's like you're losing purchasing power with the bond. It's not even paying you enough to cover the rate of inflation. And so because of that, you need to be rewarded for that, like to take on this risk. And so you get a higher yield on it. And you see these highly rated corporate bonds down to the list. The corporate bonds are considered a little bit more risky. They're going to have to pay out more on average. All right. And so, and on average, bonds are considered safer than stocks. So bonds, like the company has to pay you like whatever the coupon rate is, annually, biannually, they're going to pay you this amount. Right? Whereas stocks, you're not sure you're going to get that. Like, they pay out dividends, but it's not guaranteed. And also, like if the company, something goes wrong, well, the bondholders get paid before the stockholders. Stockholders get paid less. So there's a lot more risk associated when you buy stocks. But because of that, like you're taking on this risk, well, you're doing it so you can get a higher return. So the yields are higher for the average US stock. And then, it's going to depend on what type of company. A small company, it's going to, you're going to have to be expected to pay more than like if you're a large company like Coca-Cola that's been around for a while. And then also like these emerging stocks, you're just not really sure they're coming on the same. Well, as a result, you expect to get paid more because if you're taking on this risk because you're not really sure this company's going to work out or not. All right. So this is a good illustration of like how, risk as it increases, or you're going to expect to get a higher rate of return. Okay, so meaning and measurement risk here. So every decision carries, like you said, it's a little bit of risk here, right? Even somewhat with these U.S. bonds, not much, but they're even with the short run, there's still just a tiny bit. Right? But these initial public offerings where these companies first raise money, there's going to be very high risk because you're not sure if it's going to work out or not. Right? So the longer a company's been around, the more likely they're going to stay around. They're obviously doing something right, but doesn't mean they can't go under, but like it's less likely. Where something's just coming on, it may sound like a good idea, but it may not work out. You never know. And so you expect to get a higher return for these. Now, the expected value, this term here, what this is, it's just like an average of all the returns that you get. And what you're going to do, you're going to weight all these possible returns. And how you weight them is like what probability is it likely to happen. So the example that most people like to give for the expected value is a coin flip, all right? So you have two possibilities, heads or tails, and they both happen with a 50% likelihood. And let's say, okay, you get $1 if it's heads, 0 if it's tails. So what's the expected value? Well, you got to take the probability of each and multiply it by the return you're going to get. So if it's heads with 50% probability, you get $1. So you take 0.5, 50%, and you multiply it by $1, so it's 50%. And then you need to add the other likelihood. Well, there you're not getting any money. It's 0. So 0.5 times 0 is 0. So the expected value of this coin flip, where you get $1 if it's heads, is 50 cents. Okay. And this other term here, standard deviation. So this is kind of an overall absolute measure of risk. What it is, the standard deviation is going to be higher when there's like a larger range of outcomes here. All right. And so people, they like to avoid that. They don't like to deal with like this volatility. This is why people have insurance. You want to kind of avoid these extreme situations where have a wreck or something goes bad. You want to avoid that. So you want to the best you can, decrease your standard deviation of outcomes. All right. Let's see. And so this next example I'll kind of use to illustrate the expected value, and I'll talk about the standard deviation too with this as well. Okay, so here they're looking at two different investments, and so your net cash flow here, all right, from investment one here is you get $200 with a 20% probability. You'll get $300 with a 60% probability, and you'll get $400 with a 20% probability. Now, when you're doing these probabilities, they need to add up to 1. So, all right, they need to account for every possible, event or return that you're going to get here. And that's what this does. You add these up. So that's 1. Okay. Now it's investment 2. It's only going to get 100 with a 20% probability, but 300, the same as the other one with a 60% probability, and 500, it gets a little bit more with a 20% probability. Okay. All right. Now, Let's determine the expected value for both of these. All right, and how do you do that? Well, you got to take each of these returns, right? And you got to multiply them by the probability that they're going to happen. This is how you average it out. So you take this 200, multiply by 0.2, you get 40. 300 by 0.6, you get 180, and so on. And so you'll add all these up, and when you add them up, this gives you your expected value, so it's 300. Right. What about investment 2? The same way, you just take all these possible outcomes, multiply them by the probability that they happen, and then you add them all up, and you do the same thing with this investment 2, and you get 300 bucks. So one thing, yeah, make sure you stop and like calculate these. Make sure you're doing this right. This will help you. Like I say, if you have any issues, we'll go over this more in class, like where I'm working through them. So this one gives you expected return of 300 bucks as well, but they're not the same. Like, you know, and depending on your risk preferences, you know, you may choose one or the other. So if you're risk averse, you're going to take the one with the smaller standard deviation. Now, that'll be investment 1. And that's because there's a smaller range between these. All right. Yeah, so this bad state here is what you consider a bad state. Well, it's, you know, it happens with 20% likelihood. It's still 200 versus investment 2. Well, you know, that's only 100. So this bad state is worse for investment 2. And if you're risk averse, that's what you worry more about, this bad state. Like, I don't want this, you know, so I'd rather have this investment 1 here. All right, at least I get 200 bucks. You care more about this. But if you're risk seeking, right, you're going to choose investment 2 because you see, well, if the good state happens, where I get this 500, that's more than 400. I want this 500 bucks here. That's more important to you, all right, when you're considering like which investment you want to take. All right, so even though these both have the same expected return, their standard deviations are different. It's higher for investment 2. So a risk-seeking person would take that on, whereas a risk-averse person would take investment 1. Okay, so like I said, we kind of mentioned this before, risk and the required return. And we kind of show that table, like going from the US bills all the way down to like these emerging stocks. And like, so, you know, you start off with the treasury bills that are short-term, very low risk. That's kind of the risk-free return. But as you go down, these stocks keep getting more and more risky. And so they have to add what's called a risk premium. And you have these different things that make that up, or that add to this risk here. And because that, you know, you need a return that's going to be higher than that for you to take on this risk, for you to be able to do that. All right. Like I said, this risk-free rate, this will be, you know, kind of what everybody uses is like, you know, the 6 month or dollar, you know, or year like T-bills, because those are very low risk, not much risk at all. There's other things that can happen, like liquidity. There's a company has trouble getting liquidity. There's inflation risk. You know, there's all sorts of, there's market risk. There's all sorts of different types of risks that can come, and you got to take that into account. All right, and that's called this risk premium. That's what's on top of this risk-free return here. All right, so if you want to go back to these right here. All right, so 3.5 would be more or less the risk-free return. But then as you add more and more risk here with this 25 years, the maturity risk, all right, because you got this longer time. All right, so you're going to add a 2% risk premium. Whereas you go to these emerging stocks, well, there's a lot of risk. You don't know if it's going to work out or what. Like, yeah, it may sound like a great idea, but you never can tell. So it's going to add a risk premium of like 12.5%. Okay. Okay, so that's it for this part. This will be it for this video, and we'll go to this next. We'll skip ahead to chapter 17 because it's kind of related. You know, looking at these capital expenditure decisions, going a little more about that. All right, so hope this was helpful.